Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today, this episode is a little bit out of order, so the date that this is recorded is probably about 2 weeks before it's actually published. And in this week's episode, we are going to take a look at managing that loser, that rotten apple that we talked about a few episodes ago. We'll link to that previous episode so you can do a little bit of a refresher on that. But before we hop to this week's content, I want to give a shout out to our Discord, link in the description below. You can hop in there. It's free to join. You can say hello to myself, the other Blockhead traders. Love to hear what you're trading. Love to hear what kind of content you want to see and hear and listen about. But let's get to this week's content of managing losers. Now, this is kind of an extension to the episode that we did a while back. Again, link up below if you want to catch up on that. In that particular episode, we were coming up to an expiration Friday. I was short quite a few puts. One of them was in Apple, and then I had a few puts in Citi Group. In those positions, I went into expiration. I held them through expiration, and I was assigned those shares. I know in the previous episode, we had talked about potentially rolling those shares. However, I did not get an opportunity to roll them because the market kind of plunged and I was in a margin call at the time and the brokerage wouldn't let me do any opening positions. And while a roll is kind of, it's like keeping the dream alive, if you would, the way the brokerage sees it is it's closing out a position and then opening a new one. And I didn't have the capital to actually perform that. So I went ahead and carried them into expiration and through expiration. So I was assigned those 100 shares of Apple, and I picked up about 300 shares of Citi Group. Now, when I took assignment on those, the market was still really down. And once the market is so far down away from your strikes, and the strikes, I'm going to talk about Apple in this episode, my strikes on Apple were at 160. Now, I had collected about $10 in premium, so my break even was around $150. But at the time, Apple was trading down around 130, maybe a little bit over 130 at the time. So we're still significantly under that 160 strike price. And even if I wanted to sell down to my cost basis of 150, that still was considerable distance away from there. And when the market is really dropping, there's not a lot of premium paid on the call side because the market doesn't see the risk to the upside. So they see more risk to the downside, so the premiums are more weighted to the downside. And that creates a problem because I already have the shares. I don't want to take on more risk by selling more puts, in which case I would get assigned more shares. I basically want to take the shares that I have and sell calls against them, because if I reach my strike price and those are exercised, I get my shares called away from me. But as long as I sell that strike above my cost basis, I collect the premium for the call, plus I get the share price of the exercise value, whatever that strike happens to be. And so it wasn't really advantageous to try to sell calls when we were that far down, because around 150 was my break even. So I want to be above my break even. So they'd probably be looking at a 155 strike at the minimum, like the closest I would get to my break even would be 155. Well, that's only $5 in the money. So I'd want to pick up a decent amount of premium. But when Apple's down at around $130, that's like a 5 delta or an 8 delta. And you just don't get that much premium for that. And so what I needed to do was I needed to hold on to those shares until I get a little bit of a rally on Apple, so we charge up closer to those strikes, and then I can go ahead and sell calls against them and get more premium from it, keep that above my cost basis, so I'm basically not losing money on assignment, and then you get the extra benefit of the premium that you sell. So let's talk about this a little bit. I took assignment of Apple on June 17th. I took 100 shares assignment. My strike price was 160, so I paid $160 for them. Now, I had a cost basis of $10 less because I had been collecting short premium on those Apple shares. So I did the initial sale. I rolled them once. I netted about $10 in premium. So that puts my cost basis around $150, even though the strike was at 160. And I took assignment and I waited for the week after that. And the week after that was a pretty strong and pretty green week. I got pretty lucky. I really felt going into that assignment that Apple was really starting to slow its decline. Of course, it still could go down more, but I really, really felt that tech had really pulled back pretty hard, and I was really looking for a little bit of a rebound. So I thought I would hang on to them, wait till we get about 5, maybe 6%, 7% if we're lucky, upside, and then I'd go ahead and try to sell a call against it to collect some premium. So let's take a look at the chart. And what I have here is I have the daily chart of Apple. And I took assignment on the 17th. Down here, you can see it was trading around $130. And I waited. And we got this nice push up right about to this green line, which is the 21-day moving average. Now you can see the last time that we got an Apple rally up to the 21 moving day average, we kind of went sideways and then we dropped a little bit more. We stair stepped down. You can see the overall trend of Apple is pretty bearish. We're below the 21 day, we're below the 50 day, and we're even below this red 200 day moving average. So this is a pretty bearish chart. Things are not looking good for Apple. Now, I was okay holding Apple because to me, we're probably not rallying back to these highs of $170, $180 that we saw, back in January of this year. But for me, Apple pays a dividend. They typically have very thick, very good cash flow, very good free cash flow. And so in an economic downturn, they're going to be a source of value. And so I'm okay to hold them, waiting for them to recover. And that was why I was okay taking this assignment. However, I want to try to keep my cost basis clicking down. And so the best way that I can do that once I have these shares is to sell calls against them. And what I really wanted to see was a nice pump up on Apple, try to get up as close as I can to that $160 strike price. If I could actually get to 160, that'd be wonderful. I'd probably sell, the 170 call if we were at 160. Collect a lot of premium. My cost basis was at 150. So you're looking at a $20 upside plus your premium. Well, if you look at the chart, going up to 160 is pretty unlikely in the near term if you look at all of these bearish technical signals. So the best case scenario for me and what I decided was if we could get back to that 21-day moving average, that would be a decent place to stretch out and try to sell a call. Because the last time we hit the 21-day moving average, we went a little bit sideways and we dropped down. And you can see that right about here where Apple is, that 140, this is where this swing up kind of started from. So this is going to be an area of resistance. And so, we could break through, it could not hold, and we could crash back down. Doesn't matter to me. I want to milk some of the premium. If we bust through and we continue going higher, I would be okay getting the shares called away from me for a profit. And that's exactly what I did. So we got a nice pump up. And then on Friday, June 24th, I was able to go ahead and sell a call. Now, when I went to look at the calls, I like to sell, 30 to 45 days out. That's really where I like to sell my short premium. That's when you start really getting your theta decay and dropping down. Now, with theta decay, you're going to get a couple things that happen if the shares are actually rallying, because down here, you can see this is the volatility. And as Apple has been kind of ramping up, you get your volatility contraction. And because I'm already pretty far out of the money, as theta begins to decay faster and faster, volatility will contract. And so potentially I could even still buy those calls back for a profit prior to expiration if this thing really looks like it could punch up to 155 and get above these moving averages. It's still got a ways to go. A lot of times you're going to want to see this 21-day moving average cross this 50-day moving average, and then you're going to want to see the 50-day moving average cross the 200-day moving average before you really start getting back into a bullish trend. Right now, this is like perfectly bearish where you got your 200 and then below that is your 50 and then below that is your 21. You can see the complete opposite was true when Apple was in an uptrend. You get your 200-day moving average on the base. Above that, you get your 50, and above that, you get your 21-day. So we're really in a bear trend of Apple. This is not looking like it's going to go to the moon anytime soon. So what we're trying to do is pump and milk that premium every time we kind of ring up as closer to that strike and that cost basis. So at this point on June 24th, you're really looking at July expiration, which is, the third Friday in July, or you're going out to August expiration, which will be the third Friday in August. And the number of days to expiration in July was only like 21 or something to that effect. So a little bit more near term than I wanted to. And what happens when you get real short on that days to expiration is the farther out of the money you are, the faster the theta burns off. And so at 21 days to expiration, when you're looking at like a 155 strike, which is where I was looking, you're already about a 20 delta put. And so you've already lost a lot of your theta. So if we take a look here real quick at that option chain for July, and we look at the 155 strike, you can see it's going for at close on Friday. Now, it was a little bit different earlier when I sold, but this is a 9 delta, and it was going for about 36 cents if you split the bid and the ask. And so you're really picking up $36, $37 at 155 strike. That's, to me, it just wasn't quite enough. And so what I ended up doing was I ended up looking out to August, which was about 56 days out to expiration. So a little bit more than what I like because theta doesn't really start kicking in, burn down until around 45 days, 30 to 45 days. However, that same 155 strike was around a 25 delta. I think when I actually did the selling of it, it was closer to a 20 delta. The premium was a little bit less. I sold it for $235. You can see here at close, we were probably looking around $245, so $10 more. And let me go back to the chart to kind of show you where this lines up in my thinking. And so this is the chart of Apple. Your 155 strike is going to be up here above the 200-day moving average. So we're looking about a month and a half out of where can Apple be. And we've got to break through this 21-day. We're going to need to break through this 50-day. We've got a resistance here at 140 that we're going to have to punch through. We're going to have another resistance here at 150 that we're going to have to punch through. And this is a pretty big one. Not only did it reject previously, but we got a swing off of this here. We got another swing off of it here. And we had a couple of resistances prior to this big swing up to an all-time high. So that 150 is going to be a pretty tough level to punch through. And I don't really think that the economic outlook or the forecast for tech is going to be that great. There's a lot of talk about potential recessions, really high interest rates, reining in growth, consumer spending contraction. It really just doesn't look that rosy for companies like Apple. And so when I look at this, I feel the 155 is not that likely to get hit. I mean, it certainly could, which is why I have to prepare for that. And if I think about it, I'm going to collect about $240 on this. I've already collected $10 to get a cost basis of $150. So 155 strike is $5 above the cost basis. That's $500. Plus I sell this call here at $240. So I'm really looking at about $750 of profit at that 155 strike if I get assigned, which is the worst case scenario you could say. Otherwise, it doesn't quite get to 155 by expiration. I keep that $240 and I keep my shares and I see where Apple's trading and I potentially go again to look for a strike. And if I'm lucky, maybe Apple's up in that 150 range kind of fighting, at which point I then can sell a call, maybe a 30 delta or 25 delta from there, which won't be a 155 strike. We're going to be up in the 160, maybe even 165 strike. To mine, my cost basis is 150. Of course, with an additional $2.50 from the premium, I'm going to be down $12.50 off of that. And so you can see the potential profit is just kind of building and building and building. The other thing that somebody could say is a worst case scenario is we get rejected off of this 140 level and we drop back down and fall through this 130 swing up level and we go down further. Well, that's really not, it's terrible, but not that terrible because I'm happy to own Apple. They're going to pay a dividend. They're going to have stable cash flow in their balance sheet. So, I think it's going to weather a recession. And these are the types of things that I'm really kind of going through in my mind when I consider, how do I manage this trade? How do I take care of this? How do I maximize my value? And the key point here is I don't want to book a loss. So I could have collected a lot more premium by selling something at the 145 strike or maybe 140 strike even, and at the money, where I probably could have collected $6 or $7. But I don't really like that because if I get assigned, I'm under my cost basis. And that would just feel terrible to actually be in a position to have all these shares and essentially book a loss for it. So that's Apple. That is the trade that I actually executed on. I sold the August call at 155 for $2.35. So I collected $235 on that. I am now on the hook to have my shares called away from me at 155 on Apple should the stock trade above 155 come the third Friday in August. The other play that I have out there is I took assignment on about 300 shares of Citi Group. Now, the cost basis that I have in Citi Group is pretty varied because I had many different strikes. So as Citi Group was dropping, I was selling a put. I'd wait for it to drop another $5 or $10. I'd sell another put at the money. I'd wait for it to drop another $5 or $10. I'd sell another put at the money. And so I basically had 3 different puts on the way down with an average of a cost basis that put me around $50 cost basis, I believe, in Citi Group. And so if we take a look at Citi Group's chart, you can see we're still down here. It has not rallied back as hard as Apple. In fact, there was a couple of negative days after I got my assignment. We're really bouncing off this $45 price point, which is the low for Citi. On Friday, we had a heck of a rally of a day. We made it up almost to $48 on Friday, but my cost basis being more like 50 to 54, somewhere in there. Volatility is very low in financials. And so even looking out to August at a 55 call, it's a 14 delta pulling in maybe $40. So you can see it's not quite as lucrative at this point to sell calls against Citi. Really need it to rally up closer. It's not anywhere near the volatility of Apple, so the premiums are not anywhere near as thick. Again, Citi is in a very, very bearish trend. We basically kind of really tipped into the bearish trend around November timing. That's where you see the moving average cross all below the 200-day moving average and really stay down there. I like Citi. I like the financials. I have faith in the financials. They just did a great stress test they went through. They pay excellent dividends. Their yields are well. So I'm okay owning big chunks of the financials, but it's not as easy to sell calls against them, especially when they're in a bearish trend, because the market sees no risk to the upside. So there's no premium to the upside. And so it's really difficult to sell calls in Citi against that, like I just talked about in Apple. So in Citi, I have not sold any calls. I'm sitting on my Citi shares. I'm going to go ahead and let those shares pay me interest from the dividends that they yield. And I'm going to sit tight. I'm probably going to want a pump up here to, you can see quite a bit of resistance around maybe 52.50. Maybe 54, but that's going to be a tall order to get up there. But once I get up there, that's when I'm going to start looking out, maybe 250 further up on the call side, maybe $5. But I feel with the volatility level of Citi, that is an unlikely stretch to get much premium. And I'll just be playing the waiting game here with Citi. So that really brings us to the end of this week's episode. I just wanted to take a minute to show you some of the mechanics of what I'm doing, how I'm doing it. You can go to thetagang.com/sprocket888. You can find all my trades there. I post them, the good, the bad, the ugly. You'll see this Apple call. You'll see the past calls and puts that I've sold on Apple. You can see the premium I've collected. It is profitable. It doesn't look profitable where I am right now, but I got to be smart about how I apply my trades to it. And I just don't make trades that are going to book for a loss. I have to hang in there. It's discouraging. This is not a get rich quick scheme. This is a very slow and methodical approach where basically I take high probability trades. This call that we talked about in this particular episode for Apple has a 70% chance of making money. Basically, it had less than a 30% chance of being above that 155 strike for assignment, which if that's true, then I've got a 70% chance of keeping all $2.40 or $240 of that premium that I sold. And so, like I've said in the past, I equate this strategy of premium selling to hitting singles in a baseball game. You're hitting single after single after single. You're never going to hit that home run. You're never going to hit a grand slam. This is not a uber exciting trading strategy where, oh my gosh, you all of a sudden print just thousands and thousands of dollars. It's not the approach that I take. This is a very methodical approach. It's slow, it's boring, but it's consistent and it works. So I hope you guys have fun out there. This will be a super interesting video to look back on because by the time this airs, Apple could be at $100 and this might look really silly, or it could be at $170 and you'll be like, wow, you totally should have hung on and then sold for calls when you were much higher. Just like I always say, you enter a trade and you're happy on the direction up and you're happy on the direction down. You got a plan in both directions. You stick to the plan, and that is how you trade with no emotions. So good luck to you trading out there. I hope your week is exciting, and don't forget to think outside the block.